Hi everyone, welcome to another lesson from Lesson Up Squad. Today we'll be doing Notes to Financial Statement Part 5, which is the last part of our series. Now that we've gone through all the other notes to the financial statement, the income statement notes, the other balance sheet notes, today we'll be looking at ordinary share capital notes and retained earning notes. If you haven't watched any of our previous series, I'll just link it above. So in this example, we're doing an ordinary share capital note, and I just want to show you quickly that in this example, you will see that it says the sale of additional shares and shares brought back by the company has been correctly recorded. What that means is that the balance that you have at the end of the year is including these transactions. So you can't redo the transactions. This is your closing number, and that is the number you need to get to. Also be mindful when you're dealing with ordinary share capital, don't mix the number of shares with the cost or the price of the shares. Ordinary share capital at the end of the year was 1,828,500, so 1.8 million. So in this 1.8 million, you have included already the shares, additional shares, and the shares bought back by the company. It's already included in the 1.8. Therefore, this 1.8 million is your closing balance and not a balance that you will adjust for your question. 500,000 ordinary shares were issued on 1st July 2013, the beginning of the financial year, at 3 Rand. 90,000 additional shares were issued on the 1st August at 4 Rand. 10,000 shares were bought back on 31st March at 4 Rand. The company is authorized to sell 1.5 million ordinary shares. So this, the company, here where it says the company is authorized to sell 1.5 million ordinary shares, this is not a Rand value. This is the number of shares that the company is authorized to sell. And this should be put also in our note. I'll show you in the next slide. But it's important to always differentiate that what's the Rand value and what is the number of shares. Another thing we need to be mindful of is whenever you're repurchasing shares, repurchase of shares will always be at an average price. So how do you calculate an average price? You will see you've got your 500,000 shares at 3 Rand. So this is the number of shares you had at the beginning of the year. So to calculate an average share, you need to determine each time you've actually issued your shares and at which price you've issued your shares. So the first issue we had was 500,000 shares were issued at 3 Rand, and you've got 1.5 million Rand. Then you issued 90,000 Rand times 4 at 360,000 Rand. So what you do is you would add 590,000 on this side, and you would add 1.8 million on this side. You take your 1.8 million total divided by the 590,000 shares to give you an average price of 3 Rand 15 per share. Remember, the only time you use an average price is when you are repurchasing shares. Other circumstances, you would always use the price they give you. So when you're selling the share, you would use that price in your ordinary share capital account. It is only when you're repurchasing the shares would you repurchase it at an average price. Before we move on to doing the notes, I want to see the impact that it will have on the T account. Here you've got your balance brought down of 500,000 shares at 3 Rand that you issued. So you can see 500,000 times 3 is 1.5 million. So ordinary share capital, remember it's a capital account, it would go on the credit side. But what is ordinary share capital? Let us talk about it for a minute. Ordinary share capital is when you start a company, you can divide the company into small pieces known as shares, and you can sell these small pieces to people. So people give you money in return of getting a portion of the company. So you've often heard people say, I own 200 shares of Sasol, which means that they have a small portion of the company that they own. In return, they've given the company money. So this is what shares is for a company. Shares is very important for this company because this is the money that they use to fund the operation and all their activities. In return to the users and to these shareholders, the shareholders would then get dividends in return for these shares. Okay, so we understand now what ordinary share capital is. You understand why it's on the credit side, because it is a capital contribution for the company. We've talked about the balance at the beginning of the year. Then we've had 90,000 additional shares were issued on the 1st of August. So when you issue shares, you get more money. When you're issuing shares, you're increasing your capital. Therefore, it would be on the credit side. You've got your 90,000 shares at 4 Rand, and therefore it is on the credit side. Now, when you purchase back shares, shares will not be always be purchased at an average price. And you can see when you're purchasing shares, you're reducing your capital. You're purchasing the shares back and you're going to give the shareholders money. And therefore you would see it is on the debit side. You've got 10,000 Rand times the 3.15, the average price we've calculated in the previous slide, to give us our closing balance of 1,828,500, which is the ordinary share capital at the end of the year. You can see that all these transactions that we went through were included as part of the 1.8 million, because they had already told us that these transactions have been correctly recorded. So always be careful. If a transaction has already been recorded, that means the balance that is given to you will be the end balance, including the transaction. If the transaction has not been recorded, the balance that they are giving you is pre-adjusted balance. Let us now look at the ordinary share capital note. The ordinary share capital note is divided into two parts: the authorized number of shares and the issued number of shares. The authorized number of share part is only the number, and the issued share part is both the number of the share and the Rand value of the share that you would see on your note. The purpose of this note is to provide the users of the financial statements more information as to what happened with the shares at the beginning of the year, what happened to the shares during the year, to give us what the value of the shares is at the end of the year. So in this example, we've got the number of ordinary shares. This was given to us. The company is authorized to sell 1.5 million ordinary shares, and we've got the 1.5 million ordinary shares here. Once again, do not confuse this with the Rand value. This will always be the number of ordinary shares. So this is your format, and make sure that you know this format really well. Then you come to the part of the issued shares. In the issued shares, you got 500,000 shares that you were issued at the beginning of the year, which is the 500,000 shares were issued at the beginning of the financial year at 3 Rand each. And that is your 500,000 times 3. We did this in our T account, which gives us the 1.5 million. Be mindful that this 1.5 million is different to the 1.5 million here. This is the 1.5 million authorized shares. This is the 1.5 million Rand worth of shares that you've issued at the beginning of the year. You further issued 90,000 shares at 4 Rand each, and you've got your 360,000. So you've issued more shares, and you've got 360,000 Rand worth more shares that has been issued. Then you've purchased 10,000 shares at an average price of 31,500. You can see you are subtracting this amount because you are decreasing your capital. You no longer have these shares at issue. Also be careful you don't use the 4 Rand here. Remember, when you are repurchasing shares, you will use the weighted average price. So you're going to ask me what happens to the difference between 4 Rand and 3 Rand 15. The loss on that would go into our retained earning, or the profit that you may have in your example will always go in the retained earning. So when you're doing the ordinary share capital account, you always use the weighted average price for purchases of your shares. Do not use the price that you purchased it at. So you may have purchased the share at 4 Rand back from your shareholders, but it was only worth 3 Rand 15. Therefore, you've made a loss on that. But you would record that loss in your retained earning as part of your retained earning note. So now let's look at your retained earnings and the notes related to your retained earning. Retained earning note is comprising of the opening balance, the movement, and the closing balance. So the opening balance can be given to you, or you may be required to calculate it. The movements that happen in the retained earning include your profit from your income statement, the profit or loss from the issue of the share repurchases, dividends, and you would then have your closing balance. You would see this is the same continuation of the example, so you can understand better. In this example, we've got the balance at the beginning of the year to be 1.5 million. We've got the net profit after tax to be 428,000. You need to be very careful of that. The profit that you use in your retained earning needs to be the profit after tax. That is because retained earnings is the earnings that your company has in excess. So this is the money, this is the earnings that the company will retain for future uses. And it cannot have anything in there that shows that you still owe other people money. So therefore you would have to use the net profit or loss after tax. So after you've paid SARS, you would use that amount to say that that amount is now belongs to your company. So therefore you would use the net profit after tax and not net profit before tax. Then you've got the repurchase of shares above average price. So if you remember from our previous example, we purchased shares at 4 Rand, whereas the shares that we calculated the cost of was 3 Rand 15. So we made a loss of 0.85 cents per share. Times it by 10,000 shares will give you 8,500. Thereafter, we've got the dividend on ordinary shares to be 202,000, and the directors declared a final dividend of 25 cents. This is a very comprehensive example because you've got a share, you've got the share repurchase, you've got the profit, and you've got dividends. So to do this note, you've got your balance at the beginning of the year, the 1.5 million which was given. Then you've got the net profit after tax, and which is from your income statement. Then you've got to reduce your profit with the 8,500 that you've made a loss on. So once again, it was a loss because the share was valued at 3 Rand 15 and you actually paid 4 Rand for it. So you made an 85 cents loss per share, and therefore you're going to reduce your profit with that value. Then you're also going to reduce your profit with the dividends on ordinary share. If you are unsure how to deal with a dividend transaction, please watch the previous video. I've explained the accounts that are involved when declaring and paying a dividend and how to deal with it. But for now, you can see that both the paid and what you've declared or recommended will be part of your retained earnings. So not only the dividend that you've paid, but both the dividend you've paid and the dividend that you've declared, giving us a total of 347,400. So that's the 202,400, the dividend on ordinary shares that you've already paid, and the 25 cents per share dividend that you've already declared, the 145,000. And that gives us the closing balance of our retained earnings. So today we've gone through what the ordinary share capital is and what retained earnings is. If you guys still have more questions, please don't hesitate to reach out. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.